If you're thinking about closing your limited company, you're probably asking yourself the question, can I just strike it off? And for some directors, yeah, strike off is the right option. It's low cost, it's simple, and it gets the job done. But the thing is, if you choose strike off when you should have chosen liquidation, the consequences for you can be pretty brutal. Personal liability for company debts, being disqualified as a director, and in some cases HMRC investigations. Now by the end of this video you will know exactly what strike off and liquidation are, who each option is for, and most importantly what one fits your situation. And I'm also going to give you a framework that you can use before you do anything further. So let's start with what strike off actually means. Strike off, it's also called dissolution. It's the process of removing a limited company from the Companies House register. And once it's struck off, the company legally ceases to exist. And the way that you do it, you file something called a DSO1 form. You pay a small fee, and then Companies House publishes a notice in the Gazette, either the London Gazette or the Edinburgh Gazette, basically saying this company is planning to be struck off the register. Now from that point, anyone the company owes money to has got 2 months to object. And if nobody objects to the strike off, the company is dissolved. So it's very simple, low cost, relatively quick. But the thing that people mistake is a strike off is designed for companies that don't have debt. There's a very specific criteria. To qualify, the company must not have traded or sold anything in the last 3 months. You can't be facing any type of winding up petition. You mustn't have any ongoing agreements with creditors. And crucially of all, it's got to be solvent, meaning it can pay its debts in full. And it's the last point which is the important one. So let's say your company owes money to HMRC, to the bank, landlord, to some suppliers, and it can't pay those debts in full before you strike off, then it's not eligible for this route. So the takeaway is simple. Strike off isn't a cheap liquidation. It is a specific tool for a specific situation. You're probably asking the question, well, Chris, what if I can't afford liquidation? Now, liquidation is for a company that can't pay its debts, okay? But a lot of people might not have the £5,000 or £6,000 that it's going to cost to an insolvency practitioner. And you're probably thinking, well, could I still try a strike off? Now the answer is potentially, okay, but you've got to follow the right steps. Now a common scenario is a company owes HMRC a few £1,000s, maybe some suppliers too. There's no cash in the business account. The company owns no assets. The company stopped trading, 4 or 5 months ago. Now, realistically, because the company can't afford to pay its debts when they fall due and its liabilities are more than its assets, it should go into liquidation. But if the company doesn't have the funds to pay for the liquidation and the director doesn't have the funds to pay for the liquidation, the director might choose to apply for a strike off anyway. Now, if you go down that route and you try and strike a company off that owes money, you must write to every creditor and give them a heads up. And basically your letter needs to say, I'm applying to dissolve the company, they've got no assets and no money left. If you object, and you obviously can, if you want the company wound up instead, feel free to petition for the winding up. Now, if the debts are relatively small and the company's got no assets, it's highly likely that your creditors might decide it's not worth spending money on chasing, and they'll allow the strike off to go through. But remember, even if you do this properly, it is not a guarantee. It's not a guarantee that you won't have problems later, and I'm going to explain why a little later in the video. Okay, so that's strike off covered. Now let me walk you through liquidation, because there are 3 different types of liquidation and the right one depends entirely on your specific situation. Now, liquidation isn't one thing, okay? Each type of liquidation exists for a different situation. Now, the most common is a CVL, Creditors Voluntary Liquidation. It's for an insolvent company. Obviously, just to highlight, insolvent means you can't pay its debts when they fall due, and or your liabilities are greater than the assets. Now, in a CVL, you, the director, choose to put the company into liquidation. You've got to get shareholders to vote to approve the liquidation, and then you get a licensed insolvency practitioner who is appointed as the liquidator. And the insolvency practitioner's job is to basically sell any company assets, turn them into cash, distribute the money to creditors in the correct legal order, and at the end of it, unsecured debts that the company can't pay are written off. Now, there's also a key part directors need to understand, and that is the insolvency practitioner's job is to investigate the conduct of the director. And if they find any misconduct, the insolvency practitioner has got to take legal action. So that can be a claim against the director, they're going to put a report into the insolvency service, and ultimately it can lead to disqualification by the insolvency service of the director. And in some cases, you can be made personally liable for business debts, okay? Now, a basic liquidation in the UK, so let's say you've got a handful of creditors, say a handful's 5, you might have some assets and just a handful of staff that need making redundant. That's going to cost you around 5 to 6 grand plus VAT, okay? Now, the second type of liquidation is a members voluntary liquidation. It's an MVL for short, and this is for companies that are solvent. So basically, you can pay off all your debts in full. Now, why would you choose an MVL instead of the strike-off? Well, most of the time it's tax efficiency, because once you go through an MVL, the money distributed to shareholders is usually treated as capital, not income. And that can mean lower tax rates, so you're basically getting taxed on the capital gain as opposed to income tax, and potentially something called business asset disposal relief. That's if you qualify. So common rule of thumb, let's say your company's got over 30 grand in retained profits. An MVL is often significantly more tax efficient than striking the company off. And don't worry, I'm going to come back to what that actually means in real numbers soon, okay? Now, the third liquidation is a compulsory liquidation. And this is when the court orders the company to be wound up. And it's usually after a creditor has been chasing you for a while. HMRC do this more than anyone else. And they get to the point and go, I'm not getting anywhere with this company. I'm going to go to court and get it wound up. Now, I'm mentioning it because this is often what happens when a director tries to strike a company off and it goes wrong. So let's say I had one a few months ago. Director owed 100 grand to HMRC. Told him, you need to put this into liquidation voluntary. And he applied for a strike off, okay? HMRC objected to the strike off. Not only did they object to the strike off, they then issued proceedings against this company and did a compulsory liquidation. Now, in most cases, the consequences of a compulsory liquidation are always much more severe than if you choose the voluntary liquidation from the start, okay? So the key lesson is this. Liquidation isn't just one option. It's 3 different tools for 3 different situations. Knowing which one will fit your company and what comes with it is really important before you decide what to do, right? Now, I said at the start, there is one myth about strike-offs that's more dangerous than ever any other. And if you're considering strike-off, you've got to understand this part. The most common thing that I see, and the reason why a lot of directors get into trouble after they've struck a company off, is the belief that the debt of the company disappears. It doesn't. And this is probably the most important thing I'm going to say in this entire video. Striking off your company with debt does not make the debt disappear forever. But when you apply to strike the company off, Companies House are going to advertise it in the relevant gazette, London or Edinburgh. And your creditors have got a 2-month window to object. But let's say for whatever reason, a creditor misses that notice, okay? Your company gets struck off. and it still owes a large amount of money, whether it's to HMRC or a supplier or whatever, whoever it is. The creditor that is owed the money can apply to restore the company to the register, and essentially it treats it as if the dissolution has never happened. And in practice, HMRC watch these things very closely, okay? If there's outstanding tax liabilities and HMRC becomes aware, they're always going to object to your strike-off. It's the same with bounce-back loans, right? Lenders will block any strike-off when that money is still outstanding. So the lesson here is, if your company owes money and it's got no realistic way of paying it, a proper voluntary liquidation is almost always the best option, not just for you, but for your creditors as well. Now, I'm going to tell you about a big change that happened in December 2021 that almost nobody knows about. Before December 2021, if a company got dissolved, the Insolvency Service had far less power to actually investigate what happened. And for many people, strike-off sort of felt like, well, it was the end of the story, they could get on with their lives. Now, there was a big change in December 2021, and there was a new rule that came out, and it gave the Insolvency Service the power to investigate directors of dissolved companies retrospectively. So even after the company's been struck off, the Insolvency Service can now look at how was the company run, how was it closed down, was it closed down via dissolution just to avoid debts and it should have been dealt with through a proper liquidation? And if they find misconduct, they can pursue pretty serious outcomes, obviously disqualification and in some cases personal liability. So the key lesson here is a successful strike-off doesn't actually mean the case is closed. If you're using dissolution when liquidation's the correct route, it can still be reopened later and you can be still held accountable. But when you're in the middle of something really stressful, you know, I get it. It's tempting to grab the option that looks the cheapest and is the quickest. And that's what a strike-off looks like, certainly on the surface. But the fastest route isn't always the safest one. And yeah, listen, I get it. Dealing with an insolvency practitioner can feel pretty intimidating, but you've got to get the right advice. You've got to choose the right process, even if it feels painful short term. I promise you it can save you from much bigger problems down the line. Now, listen, if anything I've said so far has made you think I need to speak to this guy, at the top of the comment section, there is a link. Put your details in there. One of my team will call you today. We are rated excellent on Trustpilot. We're number one on Trustpilot for what we do. And we'll offer you some free guidance on what your options are. And if you don't want to speak to anyone, but you want a free guide about insolvency and all your options, go to the second link in the comment section. All I want off there, I think, is your email address, and I'll send you a free guide, okay? Now, next I'm going to show you how directors are quietly losing money that they actually had every right to keep. And this one is a bit easier to fix, but only if you know about it before you apply, right? So, even if a director does everything correct with strike-off, okay, so they're solvent, they've got no debts, they're eligible in every way, this mistake can cost them real money. And it comes down to one rule about a dissolved company that most people are never told. Now, when a company is struck off, any assets inside that company at the moment it dissolves automatically pass to the Crown. And it's called bona vacantia, literally vacant goods. Now, what this means in real life is your bank account gets frozen, any cash left in there gets passed to the Crown. Any property, intellectual property, unpaid invoices, contracts, refunds, anything still owned by the company at dissolution ends up with the government. Now, a real life example was a director who spoke to us last year. He had a one-man band consulting business. He'd had it for years and years. The company was clean, solvent, no debts. He applied for a strike-off and it went through without a hitch. And then a few months later, HMRC processed a VAT refund that the company was genuinely owed to, completely legitimate money, but by the time the refund was processed, the company didn't exist. So the refund went straight to the Crown and not to the company. Now, he did eventually recover it, but it took months. It cost him money, he had to get a solicitor involved, and it cost him a significant chunk of the money he was trying to get back. Now, if he'd have known this before he submitted the DSL1 form, he could have just waited, dealt with the refund first, and avoided the whole mess. Now, the key lesson here is before you apply to strike off a company, make sure you empty the company properly. So close the bank account down, okay? Move the funds out legally. Distribute any remaining assets that the business holds. And resolve anything pending with HMRC, especially expected refunds. Basically, make sure there's nothing in the pipeline that could land after the dissolution, because you're going to lose it. Now, if your company can pay off all its debts, and let's say it's got over 30 grand left in the bank, I'm going to explain the option that's often best and why it can save you a lot on tax. So this is the general situation we get all the time. The directors built a successful business, the company's profitable and solvent, and they're ready to wind it down and move on. So they'll ask their accountant, how do I close a company? And they're told, well, just apply for a strike off. That's not wrong advice, but it's often incomplete. Now, if your company has retained profits above 30 grand, a member's voluntary liquidation will very often put significantly more money in your pocket than a strike-off. And here's why. With a strike-off, you can typically extract up to 25 grand as basically a capital distribution, and it's taxed under capital gains rules. But anything above 25 grand, taken out as part of a strike-off, can be treated as income, which, depending on your situation, could mean 40 or even 45% on the excess. Now, with an MVL, distributions are treated as capital, not income, and that means you're usually paying capital gains tax. And if you qualify for, it's called business asset disposal relief, used to be entrepreneurs relief, the effective rate can be as low as 10%. Now, we put that into real numbers. Imagine you've got 150 grand in your company's retained profits. Option one is you strike it off. So your first 25 grand's taxed as capital, the remaining 125 potentially taxed as income. So total tax bill could be around 50 grand depending on what rate of tax you pay. Option two, you've still got 150 grand in the company, you take it out, but it's all treated as capital. Now, with business asset disposal relief, the tax could be around 15 grand. Now, that is a difference of roughly £35,000 for the exact same company and the exact same amount of money. And yes, an MVL is going to cost you money. It might be 2, 3, 4 grand, depending on the complexity of it. But in many cases, it's going to be a fraction of what it saves you. Now, the lesson is, if your company is solvent and you're closing it down, don't assume strike off is the best route just because it's the simplest. Get the numbers looked at properly before you decide, ideally with both an accountant and an insolvency practitioner, because if you've got profits above £25,000-30,000, that one conversation could save you a lot of money. Right. You now understand the main routes and you understand where the dangers are. Now let me give you a practical framework that pulls all of this information together. Basically 4 questions that you can ask yourself which will tell you which option is the best route for you. Question 1. Can you pay all your creditors in full? HMRC, suppliers, lenders, landlords, employees. If yes, you may be eligible for either a strike-off or an MVL. Keep going. If no, you really need a liquidation. Full stop. Do not attempt to strike off the company if it can't pay its debts. That application is likely going to be blocked. It can draw attention to the situation and your options can narrow. Now, a liquidation, if you do it proactively, is almost always better for not only your personal position, okay, but actually better for your creditors, because it draws a line in the sand and it stops you being forced into compulsory liquidation by one of your creditors. Now, question 2, if you've got more than 25 grand in retained profits or assets, if yes, and the company is solvent, speak to an insolvency practitioner about an MVL before you do anything else. Remember, in most cases, the tax saving you get with an MVL will outweigh the cost of the process. And if the value is genuinely below 25 grand and the company's clean, strike off is generally the right route to go. Now, question 3. Has your company done anything in the last 3 months that makes a strike off invalid? So specifically, has it traded, has it sold stock, has it changed its name, or has it entered into any agreements with its creditors in the last 3 months? And if it's a yes to any of those, you're not currently eligible for strike off, even if you're solvent. So the options there are, you can wait until you're outside the relevant period, or if you're insolvent, you can use liquidation instead. Now, question 4, are there any loose ends that you're not 100% sure about? I don't know, HMRC correspondence still ongoing, a supplier balance you've not fully settled yet. You've got a refund that you're expecting for VAT, corporation tax. You've got a contract that hasn't been properly closed down. If yes to any of those, you need to resolve them before you apply a strike off. So do not start a strike off with loose ends. Either they'll block the application now, or it will surface after the solution when you've no longer got a legal entity to deal with them through. Lot of stuff to say there. Now, when you clicked on the video, you might have been thinking, right, strike off, get it done quickly, move on. But hopefully now you know the truth. The simple option is only simple when the company's clean, solvent and properly closed down. So I want you to use 4 questions, be honest about the situation, and if you're unsure, get advice before you file anything. That one step can save you a huge amount of stress and sometimes a huge amount of money. Listen, if you want somebody to speak to today, go to the comment section below, click on the link and one of my team will call you. And if you want to find out more about liquidation and the things you should do before you start an insolvency process, go and watch that video there. Thanks for your time, Chris Worden. Bye-bye.